Welcome back to Colin and Bears. Today's a big one, folk. We're diving deep into a whirlwind of market activity, policy shifts, and some very interesting stock movements. We'll be unpacking everything from surprising inflation data to Trump's latest tariff announcements, and even individual stock performances that might have you rethinking your portfolio. We are going to analyze those recent market trends, because it is the foundation for understanding the forces at play. We'll specifically laser focus, on that PPI data that came out, and, let me tell you, it threw a lot of people for a loop. We'll also dissect President Trump's reciprocal tariff announcement, what it means, what it doesn't mean, and the potential ripple effects. And of course, we'll be looking at some individual stocks that have been making headlines. We will discuss all the impact, the real impact, of macroeconomic factors and policy decisions on your investments. We will not say simple words, but we'll try to understand the root cause. Let's get started. Alright, let's dive into some seemingly contradictory data, the PPI numbers, producer price index. We just got the latest figures, and at first glance they appear to paint a picture of rising inflation, and usually you will be right, but not this time. We saw that the overall PPI rose by 0.4% in January. Now, that's higher than the 0.3% that economists had predicted. On the surface, you see that number, and the immediate reaction is, oh no, inflation's heating up again. And the core PPI, which strips out those volatile food and energy prices that increased by 0.3%. Okay, that was in line with expectations, so no big surprise there. So far, so inflationary, right? But here is the crucial part. The market reaction was surprisingly mild, almost a shrug. People weren't panicking, there wasn't a massive sell-off. Why? Why the muted response to what looks like inflationary pressure? Well, it all comes down to how the Fed interprets this data. The Federal Reserve, as many of you know, doesn't just look at the headline PPI number. They dig deeper, ma'am. They're particularly interested in the components of the PPI that feed into their preferred inflation gauge, which is the PCE, the Personal Consumption Expenditures Price Index. And guess what? Those specific components, the ones used in the PCE calculation, actually showed declines. Things like financial services and healthcare softer. This is key, because of that, Morgan Stanley and other major financial institutions are now predicting that the core PCE, the Fed's favorite metric, will only rise by 0.3% month over month, considerably less alarming than some of the other inflation data we've seen recently, and significantly lower than the CPI increase. So, the bottom line. The market is betting that this PPI report, despite the initial headline numbers, might actually ease the Fed's concerns about persistent inflation. It suggests that the path to lower inflation, while maybe not perfectly smooth, is still intact, and that, my friends, is why the market didn't freak out. So, we've seen this seemingly contradictory picture with the PPI higher than expected inflation, yet a strangely calm market. But remember, that little detail about the PCE components, that's our bridge to understanding the broader economic landscape, and specifically, what's happening in the job market, and that, my friends, is reflected in the latest unemployment data. Let's take a look. Initial jobless claims, the number of people filing for unemployment benefits for the first time, came in at 213,000. That's below what economists were anticipating. They were expecting 215,000. Now, a couple of thousand might not sound like a huge difference, but in the world of economic indicators, it's a significant signal. It suggests that the labor market is holding up. It is more resilient than some might have feared. Imagine you run a business. You will not fire workers if you are not expecting some storm, right? And it's not just a one-week fluke. The 4-week moving average, which smooths out some of the weekly volatility, also ticked down from 217,000 to 216,000. Again, a subtle but important shift. This tells us that on average, fewer people are losing their jobs. But perhaps the most telling figure is the number of continuing jobless claims, those individuals who are already receiving unemployment benefits. That number dropped to 1.855 million, down significantly from the previous 1.886 million, and importantly, below the expected 1.88 million. That is a clear indication. This is not just about fewer people losing their jobs initially. It's also about people finding new work and getting off of unemployment. This speaks to the underlying strength and dynamism that's still present, at least for now, in the U.S. economy despite all the inflationary headwinds. People are getting hired, and that is always a good sign. So, we've talked about the surprising resilience in the job market even amidst inflation jitters, but here's another major force at play, and it's coming straight from the White House. I am talking, of course, about President Trump's latest move on trade, the reciprocal tariff. Imagine this, a global chess game, where every move is countered with an equal and opposite reaction. That's essentially what this policy aims to create. Trump has formally announced a reciprocal tariff plan, and it's slated to be implemented within weeks. This isn't some far-off, vague threat. It's happening, and it's happening soon. The stated goal: to level the playing field. The core message is simple, yet incredibly powerful. If you tax products, we will tax yours. It's an eye for an eye, tooth for a tooth approach to international trade. And the deadline, at least the initial phase, is set for the 1st of April. Now, that date might sound familiar, April Fool's Day, but I assure you, this is no joke. It's designed to give some room for negotiation. Think of it as a ticking clock, forcing other countries to the bargaining table. But here is where it gets even more havoc. This isn't just about slapping duties on a few specific goods. It's far broader than that. This policy covers the traditional import tariffs, of course the ones we're all familiar with, but crucially it goes much deeper. We're talking about addressing hidden subsidies, those sneaky government supports that give some companies an unfair advantage, and even non-monetary trade barriers. Those are those regulations and red tape that can make it incredibly difficult for American businesses to compete abroad. So what's the real takeaway here? Uncertainty. Massive wave of uncertainty is about to wash over global markets. We're entering a period of potentially intense negotiations, retaliations, and shifting trade flows. And for us as investors, that means we need to be prepared for volatility. And that uncertainty we just discussed concerning those sweeping trade policies, well, it's not confined to just tariffs. Consider this a situation where TIR is a new wrinkle in the jewelling landscape, one that's sending ripples through a very specific sector, defense. I am talking, of course, about the prospect of significant cuts to military spending. Now, President Trump suggested, and I emphasize suggested, a potential 50% reduction in U.S. military spending. Let that sink in for a moment. Half. That's not a minor trim, that's a radical reshaping of the entire defense budget. Imagine the impact and consider all the businesses involved. It's a huge, huge deal. But, and this is a big but, this statement flies directly in the face of what we've been hearing from other side, the newly appointed defense secretary. He's been quite vocal in his opposition to any spending cuts that would bring the defense budget below 3% of GDP. So, we have a clear contradiction, a clash of visions, a fundamental disagreement on where defense spending should be headed. This isn't just a minor policy difference. This is a potentially massive shift, and the market predictably reacted. Defense stocks took a beating, and is significant beating. We saw Northrop Grumman, NOSA, for example, down more than 3%. That's a direct reflection of the fear and uncertainty swirling around this potential policy change. But I will add this, and this crucial. This isn't the only headwind facing the defense sector right now. There are existing concerns weighing on these companies. We've got the ongoing possibility of a very thorough audit of the Department of Defense, an audit that could uncover, shall we say, inefficiencies or questionable spending practices. And separately, we have the Russia-Ukraine conflict, where TIR has been increasing talk of peace negotiations. Progress on that front, while obviously positive for global stability, could further dampen demand for military hardware. So, what's the takeaway here? The defense sector is facing a confluence of challenges, contradictory policy signals, potential audits, and shifting geopolitical dynamics. It's a period of heightened uncertainty, and investors need to tread very carefully. We have conflicting information, and we need to keep tracking. Okay, we've seen the market's surprising reaction to inflation. We've touched upon Trump's aggressive trade stance, but now we need to address the elephant in the room, the massive, and I mean massive, issue of U.S. debt. And for this, we turn to a voice of considerable weight in the financial world, Ray Dalio. He is not just any analyst. This is the man who predicted the Latin American debt crisis. So when he speaks, we should all listen. Dalio's recent warning. It's not subtle, it's not couched in cautious language. He's talking about a potential death spiral for U.S. debt. Strong words, and even stronger implications. Imagine a patient on the brink of a heart attack. That's the analogy Dalio's using for the U.S. economy right now. He's essentially saying, we need urgent intervention, or we're headed for disaster. So, what's driving this alarm? Let's break down the numbers, because they are frankly staggering. Dalio's primary concern is the unsustainable budget deficit. He's urging a drastic reduction from the current 7.5% of GDP down to 3%. That's a huge cut, and politically incredibly difficult to achieve. We are not speaking about percentages, but about a big, very big amount of money. But look at the total debt, $36.22 trillion. Let that sink in. of that $28.9 trillion in public debt money the government owes to external creditors, and the interest payments on that debt a whopping $1.1 trillion in 2024 alone. That's 4% of the entire US GDP, and a staggering asterisk, 22% asterisk of all federal revenue. Nearly a quarter of every dollar the government takes in goes straight to paying interest. That's money that can't be used for infrastructure, education, healthcare, or anything else. But it gets worse. Two major factors are exacerbating the problem. First, interest rates are riding Mel. The Fed's tightening cycle means the cost of borrowing is going up, and that applies to the government too. Second, an increasing proportion of U.S. debt is being held by foreign entities. In 2023, 30% of U.S. debt was held by foreign investors. This means a significant chunk of those interest payments are flowing out of the U.S. economy, rather than stimulating domestic growth, and Dalio's warning extends beyond just government debt. He's also sounding the alarm on the private credit market, a rapidly growing and arguably less transparent sector that's now surpassed $2 trillion. He is pointing the finger at hidden risks and the potential, the real potential, for another death spiral scenario. The situation is, at the very least, concerning. It needs a very, very close look. So, we've navigated a sea of macroeconomic data, policy shifts, and geopolitical risks. Now, let's shift gears completely and zoom in on a specific company that's been making waves. AppLovin, ticker symbol AP, and after their recent earnings report, surge is almost an understatement. The stock, my friends, absolutely exploded. It is on fire. We're talking about a 24% jump in a single day. Now, many of you might be familiar with AppLovin, particularly if you are in the mobile gaming or app development space. But for those who aren't, a quick primer. They provide a platform for app developers, helping them with marketing, monetization, and analytics. It is simply put, like providing tools, and they do it well, very well. But here is where it gets really interesting. Let's look under the hood at the valuation, and I'll explain why. The surge might have some people raising their eyebrows. The forward price to earnings ratio, that's the PEA key metric for valuing a company, is sitting at a lofty 76.5 for the 2025 estimated earnings, and for 2026 still high at 60.7. Now compare that to some more established, slower growth companies, and you'll see it is significantly higher. But the high PE can be justified if a company is growing at a breakneck pace, right? Let's investigate. Well, AppLovin is projecting impressive revenue growth, 35% for 2025 and 26% for 2026. Very, very strong numbers. This is the speed of a startup almost, but is it enough to justify that sky-high valuation? That's where another metric comes in. The PE ratio, price, earnings to growth. This gives us a more nuanced view relating the PE to the expected growth rate. And if you remember some of the previous analysis we did, you'll see how this plays into the bigger picture. For 2025, AppLovin's PE ratio is 2.1, and looking further out, the 5-year forward PE, a staggering 3.8. Generally, a PE ratio closer to 1 is considered more fairly valued. So these numbers definitely suggest a premium is being baked into the stock price. A big, substantial premium. And finally, let's take a quick glance at the technical picture. This is a volatile stock. Folks, this recent jump, it's created some massive gaps in the support levels. What does that mean? It means that if the momentum shifts, if sentiment turns, the stock could have a long way to fall before it finds solid support. It's a high reward, but also a high risk situation. High risk, high reward. Keep that in mind. All right, we've talked about established players, market giants, and companies undergoing significant shifts. But what about the new kids on the block? The recent IPOs, the companies that are still, shall we say, finding their footing in the public markets? That's where RDDT, ticker symbol RD, comes in. And I have to caution you up front. This is a very different beast than what we've discussed so far. Now, I'll be honest with you, I usually put a rule for myself. I don't dive deep into companies that have been public for less than a year. Wide data, pure data, the technical and even fundamental analysis is limited, Mel. It's like trying to predict the weather based on a single day's date. You just don't have enough information to draw reliable conclusions. The market hasn't had time to really figure out what these companies are worth, how they'll perform under pressure, what their true long-term trajectory will be. So many of you have been asking about RDDT. and its recent performance has been so well eye-cack that I felt we needed to at least address it. But remember, we're in somewhat uncharted territory here, so let's look at what we do know. And the first thing that jumps out, the valuation. And based to say the least, we're looking at a forward price to earnings ratio of 237 for the 2025 estimated earnings, 237, and even for 2026 it's still at 106. Those are numbers that would make even the most seasoned growth investor blink. You usually see that multiple on very young companies. But, and this is a crucial, but RDDT is project explosive revenue growth. We're talking 125% for 2025 and 122% for 2026. Those are numbers that frankly are hard to ignore. That is insane growth. Now let's bring in the PE ratio again to try to make sense of this. For 2025 it's 1.89, still elevated but somewhat more palatable than the raw PEA. But look at that 5-year forward pay. 5.9, that's in the stratosphere. It suggests that a tremendous amount of future growth is already priced into the stock, a lot of optimism, a lot of expectation, and finally, the technical picture. Because this is a recent IPO, we have very limited data to work with. The support levels, they're far apart. What does that tell us? Buckle up, because this is likely to be a wild ride. High volatility is almost guaranteed. This is not a stock for the faint of heart. It's a roller coaster, and you need to be prepared for some serious ups and downs. So invest or speculate with caution. And definitely, do your own research. From the somewhat dizzying heights of Reddit, let's move to another player in this digital land, to one that's familiar to many of you, particularly if you are active in the markets. Robinhood, ticker symbol HOOD. And the story here, like with any brokerage, is intrinsically linked to the overall market environment. We need to remember, the basic concept is the same. Always think of it this way. Brokerage stocks, generally speaking, are like surfers riding a wave. When the market's up, a big, beautiful, cresting wave, they thrive. More people are trading, more transactions are happening, and even though Robinhood famously offers commission-free trading, they still benefit. You see, they make money by selling order flow data to third parties. The more activity, the more valuable that data becomes. It's a simple, powerful dynamic. More trades, more money. Less trades, less money. Now, let's dive into some of the key metrics, and I want you to keep that surfing analogy in mind. The forward PE ratio again. That's our price to earnings. A measure of VALs is 55 for the 2025 estimated earnings and 45.2 for 2026. So is it high? Is it low? Well, compared to some of the tech darlings we've just discussed, it might seem almost reasonable, but remember, we're in a different sector here. Brokerages are cyclical. They're tied to the ebb and flow of the market. And what about growth? Well, the projected revenue growth is interesting. 6% for 2025, that's modest to say the least. Then, a jump to 21% for 2026. That's more like it, but it still begs the question, what's driving that anticipated surge? What wave are they expecting to catch? And here's where I have to raise an eyebrow, the 5-year forward growth consensus. The collective wisdom of the market analysts is a whopping asterisk, 63% asterisk. Now, I've been in this business a long time, and I have to ask, really? 63%? Are we expecting some kind of unprecedented, sustained, multi-year bull market? Is that a realistic assumption? Or is it, perhaps, a bit of wishful thinking? I put a question mark there because I really do not know. It is an open question. Finally, a quick word on the technicals. Like some of the other stocks we've looked at, Robinhood has wide support ranges. This means it's prone to big swings. It can go up a lot, and it can go down a lot fast. So, if you are considering Robinhood, be prepared for volatility. This isn't your grandfather's steady dividend stock. This is a different animal altogether, you must know. You really must know what you're investing in. You cannot pretend, right? So the bottom line is this. I am not tracking the fundamentals because, as many of you know, it changes. Fast. Really fast. That's the core concept. I believe you need to keep always present. It is tied intrinsically to the market. And that roller coaster we saw with Robinhood, with its dependence on market sentiment, well, it stands in stark contrast to a company like Palo Alto Networks, ticker symbol PANW, a securities giant that operates in a very different realm. You see, while market fluctuations can dramatically impact brokerages, the need for robust high creek, that's a contrary, regardless of whether we're in a bull or bear market. It is a necessity, a must amount. we've just gotten their latest earnings report, and while the stock might not be experiencing the explosive growth of some of the companies we've already discussed, there are some key takeaways here. It is interesting to see the differences, and what really moves the needle first, the forward valuation. It remains high. We're looking at a forward PE of 61.8 for the 2025 estimated earnings and 54.2 for 2026. This is definitely a premium valuation, suggesting that the market expects continued growth from Palo Alto Networks. And is it really growing? Well, yes, it is, but at a different pace than, say, Reddit or AppLovin. Projected revenue growth is 11% for 2025 and 14% for 2026. Hello, everyone, and welcome back to Call In Investing, but not the triple-digit figures we saw earlier. The 5-year forward growth market consensus is around 20%, again strong, but within a more, shall we say, traditional growth range for an established tech company. Now, here is where it gets particularly interesting for investors, and I want to explain what happened. Look at the technical picture. Palo Alto Networks has strong support levels below the current price. Think of these as safety nets, levels where buyers have historically stepped in. What does this mean? It means that barring some major unforeseen negative news, a dramatic sudden collapse is less likely. The downside, at least in the short term, appears to be somewhat limited. Of course, nothing is guaranteed in the market. But this technical setup provides a degree of comfort for those holding the stock. It will not fall, and then keep falling. So you have to consider that multiple support levels, and then ask yourself, what could really move the needle to the downside? From the Zygrese realm, and all those complex figures, let's shift our focus to a company that's been, shall we say, experiencing a bit of a revival lately. Tesla, ticker symbol, TSLA. And revival can be a good thing, a very good thing, but it depends, right? We've seen this stock be the darling of Wall Street, and we've seen it take some serious hits. It's been a roller coaster, to put it mildly, but the question I always ask, the question you should always ask, is this: what's driving the movement? Is it hype? Is it hope? Or is there something fundamental changing? Well, yesterday we discussed here how Tesla had a crucial threshold, a line in the sand, the $350 mark. Today we saw something interesting. The stock broke above that $350 level. Now, that in and of itself is significant. It's a sign of potential strength, a hint that the bulls might be starting to regain some control. And because of that, this increases the probability of reaching $361. It's almost a chain reaction, one positive move leading to another, potentially. But, and I always emphasize the buts, we need to be cautious. This is a short-term trend reversal. We're seeing a bounce, a bit of a recovery after a period of decline, however, and it isn't important. However, the overall downtrend, the bigger picture remains intact. Until Tesla decisively breaches that $361 level, we're still technically in a downtrend. It's like climbing a mount. You might have a good day, a burst of energy, but you are still a long way from the summit. So what are the smart money? What are the big players doing? What is their reaction? Well, let's look at the options market. That can give us some valuable clues. And what it's telling us right now is interesting. It indicates a potential $10 move in either direct by Friday's close. That's a significant range, suggesting that volatility is still very much in play. It's like a coiled spring, ready to release in one direction or the other. So what's the key highs here? What's the number you need to keep your eye on? It is, again, $361. A break above that level. That would be a major confirmation, a signal that Tesla is truly returning to its previous trading range, escaping the downward pressure. It would be a victory for the bulls, and a sign that, perhaps, the worst is over, but until then, we remain in a wait-and-see mode, cautiously optimistic, but aware that the bears are still lurking. We remain, as always, vigilant, and that uncertainty we've been navigating. It's about to take a very specific form, impacting a battle that's been brewing for years, decades even, the global Miakunda showdown. I am talking, of course, about Intel versus TSMC, a technological clash, a David and Goliath story, and frankly, a situation that has major implications for your portfolio, especially if you hold chip stocks. It is a must to understand what is going on. We just talked about those potential military spending cuts, the trade disputes. Well, all of that is somehow in the background. You see, it creates a context, a backdrop of national interest and strategic competition. And that's where this gets really interesting, because the Trump administration, well, they have decided to put their thumb, and I really mean put their thumb on the scale. They've proposed three distinct options, all designed to dramatically strengthen Intel's position in the semiconductor industry. But, and this is a colossal but, these options come potentially, and I mean potentially, at the direct expense of Taiwan Jiagring, the giant, the undisputed king of chip manufacturing. Let's break down these options, because they are, frankly, fascinating, and quite possibly game-changing. Think of these proposals as a three-pronged attack, each with its own unique implications. It is almost a strategy, and it's complex. Onsium number 1, force. And, you could say, force TSMC to build an advanced packaging facility, right here, in the United States. Now on the surface that might sound rising of bringing high-tech manufacturing back to American shores, but TSMC, they're hesitant, they're dragging their feet. Why? Because building such a facility is incredibly expensive, technologically complex, and frankly the economics of it, in the US, are still uncertain. It's a massive investment with a questionable, at least for now, return. They have to consider all the factors from logistics to costs. Momentum number 2. This is where it gets even more intriguing. A forced marriage of sorts. The proposal, a joint venture between TSMC and Intel, sounds clearer, right? But the subtext is clear. Technology transfer melm, essentially forcing TSMC to share its cutting-edge know-how, its secret sauce, with Intel. Imagine the implications of that. It's like asking Coca-Cola to share its secret formula with Pepsi. It's a huge deal. And finally, option number 3. This one is perhaps the most direct, the most aggressive. The proposal: Intel would simply take over the future packaging services for TSMC's based customers. Just take them. A complete shift in the supply chain, orchestrated by government intervention. It is, at the very least, bold. So what's the overall impact for TSMC? Massive uncertainty, a cloud of doubt hanging over their future operations, their market share, their entire business model, and, by extension, this ripples throughout the entire chip industry. Think about companies like NVIDIA, like AMD, like all the tech giants that rely on TSMC's cutting-edge manufacturing. Any disruption to that supply chain? It has the potential to impact everything from graphics cards to SAB-6 to, well, you name it. It's a tangled web, and this is pulling at a very significant thread. We need more than ever to keep watching. So, we've seen this intricate, almost choreographed dance between Intel and TSMC, a battle for neoconduct supremacy. But what about the other players in this high-stakes game? What about the companies caught in the crossfire, the ones relying on these giants for their very survival? Let's turn for a moment to AMD, ticker symbol AMD. And I want to highlight something small, almost insignificant on its own, but potentially revealing when viewed in the broader context. We're not talking about earth-shattering news here. No massive earnings surprises, no ground-ring product announcements. Instead, we have an insider transaction. An executive vice president at AMD recently purchased $500,000 worth of stock. Now, for a company of AMD's size, that's not a huge amount. It's not going to move the needle on its own. But, and this is a key point, it's the first such purchase by this executive in * 12 years, 12 long years. That's a generation in the tech world. Think of it as a symbolic gesture, a quiet vote of confidence. It's like a whisper amidst the roar of the market, a small signal that perhaps things aren't as dire as some might fear. It's a suggestion, an affirmation that, at least, from within the company, here is a belief in the long-term value, in the underlying strength, despite all the external pressures. But here is another, and it is more technical sign that I would like to show to you. And it's simple. No new loads. While the stock might not be soaring to new heights, it's also not collapsing. It's holding its ground, refusing to sink further. And in a market environment characterized by volatility and uncertainty, that, in itself, can be interpreted as a positive sign. It suggests a degree of resilience, a base level of support that's holding firm. It is a simple, but at the same time crucial, sign. So, we've navigated a whirlwind of market data, policy twists, and corporate battles. But before we wrap up, I want to take a moment to connect with you, the Colin investing community. Because, ultimately, all this analysis, all these insights are for you. To help you make informed decisions, to empower you in your investment journey. And that journey, it's a partnership. It's about us learning together, growing together, navigating this complex world of finance together. And that's why I am so passionate about this channel, about creating a space where we can share knowledge, discuss strategies, and support each other. I learn every single day from your comments, your questions, your perspectives. It is a constant learning. So, if you found value in today's deep dive, and I truly hope you have, please take a moment to show your support. It's simple, but it makes a huge difference. Hit that like button. Asterisk, it tells the algorithm that this content is valuable, that it deserves to be shared with a wider audience. And subscribe to the channel, join our growing community of informed investors, and stay up to date on all the latest market moves, analysis, and strategies. We've got some exciting content planned, and I don't want you to miss out. But it's not just about clicking buttons, it's about engagement. It's about participating in the conversation. Share your thoughts, your questions, your own insights in the comments section below. What struck you most from today's analysis? What are watching in the markets? What companies are on your radar? Let's learn from each other. Let's build a stronger, more informed community together. And I read all the comments and I answer to most. And finally, if you are looking for a reliable, powerful, and cost-effective brokerage platform, I encourage you to check out Interactive Brokers IEB. I use them myself, and I've been consistently impressed with their tools, their resources, and their commitment to low fees. You'll find the link in the pinned comment below. Click through to learn more. It's a great way to support the channel and potentially enhance your own investing experience. Remember, every single click you do really helps. So, thank you. Thank you for your time, your attention, and your commitment to becoming a more informed investor. I am truly grateful to be on this journey with you. Until next time, stay informed, stay engaged, and keep investing wisely.